Welcome back to the Retirement Fiduciary Podcast, your classroom for no BS financial education. A place where we have authentic discussions about retirement planning, investment management, tax reduction strategies, insurance estate planning, and more. Here's your host, Adam Koos, President, Portfolio Manager, and Senior Financial Advisor at Libertas Wealth Management Group.
All right, what's going on, everybody? Thank you so much for joining us today. As always, let's get started with a few housekeeping items. If this is your first time listening or watching, thank you so much for joining us. The Retirement Fiduciary Podcast is an authentic educational show aimed at providing honest, candid, fiduciary-driven insights for individuals and couples all over the country. The podcast is produced bi-weekly as we cut through all the noise in the markets, dropping no-nonsense, unbiased knowledge to help you make work optional someday, all while living the lifestyle you've always wanted. So be sure to subscribe on YouTube, Apple Podcasts, and Spotify, and you can also find more of what we share on TikTok, Instagram, Twitter, or X as they call it now, as well as YouTube. Finally, to learn more about what we do and how we work with our clients, all you have to do is head over to libertaswealth.com. Again, that's libertaswealth.com, and check us out there. All right, so enough of the housekeeping. Today, we're talking about speeding up the market, what every investor needs to know about the new trading rules that just went into effect. You're going to hear about them if you haven't heard about them already, and let's just say that they're not exactly self-explanatory. So we're going to talk about those first and foremost today, and then we're also going to jump into a few other little kind of, we'll call it 101s about trading bonds, stocks, and ETFs. So let's go ahead and get started with a quote. So our quote of the day, Benjamin Franklin, founding father and face of the C-note, an investment in knowledge pays the best interest. So you're already checking out this podcast, this screencast, which means you're already doing more than most people do. So without a doubt, the best interest you can ever get isn't from bond interest. It's not from stock dividends. It's an investment in yourself and your own knowledge. So that's our quote of the day. Moving on, let's talk about the trading rules right up front. First thing to understand is that trading is a whole lot more complicated than you think. I think most people think that when you place a trade to buy or sell an investment, you place that trade and you own it, or you place a trade and you sell it, and that's it. You know, it's pretty simple, right? But there's a whole lot more that goes on behind the scenes. First thing is that there's a couple things to keep in mind. First is the trade date or the transaction date. That's the first thing that happens. And in other words, when you place a trade to buy or sell an investment, it happens on that day or that time, typically during market hours, which are between 9:30 a.m. and 4 p.m. Eastern. So for the people who work on the West Coast, they've got to get up pretty early in the morning. But I guess the good news is their days end a lot earlier than those of us on the East Coast. So the first date to keep in mind, or the first important date, is the trade date. Now, what normally happens, or what used to happen, is that when you place that trade, let's just say on a Monday, then the trade would settle. In other words, that's when the money would need to be in your account. It's when the trade is officially official. It's when the securities would be due. It's when the money becomes available if you're selling an investment. So typically it would be 2 days later. So in the past, if you placed a trade on Monday, then it would settle on Wednesday, which was 2 days later. And that's when, if you were selling an investment, your money would be available to have it ACH'd or wired to you. If you were buying an investment, that's when the money would be required to be available for the trade that took place 2 days ago. And then if you're talking about options or futures contracts and things like that, then we'd be talking about when securities would need to be due. Let's just say if we're shorting an investment, for instance, which we will talk about that just a tad bit today. So most securities, again, have been on a T+2 settlement date, but as of May 28th, it all changed to 1 business day, which overall is a really good thing. Why, or, what's this mean to you? Well, first of all, it's more convenience. So, you can get access to your money faster. When you need funds for vacation or even an emergency, if your portfolio is fully invested in 100% or say 97% in stocks and bonds and commodities or whatever your portfolio makeup is, then if you need money tomorrow, then you can literally place trades today and it'll settle tomorrow in 1 business day. Obviously, we have to keep in mind holidays. Weekends obviously are not business days. So if there's a holiday or a weekend, let's just say we place a trade on Friday, it's not going to be available till Monday. That would be +1, so 1 business day. Monday. But if we're talking like a Memorial Day weekend like we just had, or like Labor Day weekend, we place a trade on Friday, the holiday's Monday, it would settle on Tuesday. But bottom line, it just means that it's more convenient. We have more access to it faster. However, you got to pay a little bit closer attention, because if you ever place a trade and the money needs to be due tomorrow and you haven't placed enough funds in the account, then obviously there's going to be a problem with the trade. You might end up having your account restricted and so on. So that's what the new laws mean, and pretty exciting stuff. Like I said, overall positive. Let's change gears and just talk a little bit about stock trading. Just kind of some did you know, we're investments 101, so to speak. First thing we'll talk about here is buying stocks. Real simple, right? Whenever you buy a stock, it's technically called going long the stock. And in case you've ever wondered what shorting is, it's the opposite of long. The problem is most people never talk about being long stocks. That's more kind of jargon in the industry. So whenever somebody talks about buying stocks, they get it. People understand. But when they say they're shorting a stock, all of a sudden it gets really, really confusing because they don't quite understand that it's the opposite of buying. So buying a stock, we buy it at $50 a share. We want it to go up in value, obviously, if we're long the stock. So if it goes up to $55 a share, then we made 10% and we're happy people, right? Shorting the stock is the opposite. When you short a stock, what happens is you're selling shares you do not own. And we'll say using the same numbers, so at $50. So we're selling shares we do not own. We're essentially borrowing those shares from a financial firm of some sort, brokerage firm, broker dealer, market maker. And we're selling those shares, let's just say at $50 a share. Then we're hoping the market goes down, or in other words, the stock goes down. And if the market goes down, let's just say from $50 per share in this stock to $45 a share, we just made 10% on the market going down, because what we do is we cover the short position, which just simply means we're buying those shares back that we sold, that were not ours. We're buying those shares back at $45 a share, and then we deliver the shares back and we get the difference on the downside. The easiest way to explain this in an analogy is we'll just use a kid's story. So let's just say I'm riding around the neighborhood in my bike, and I'm 15 years old, and I've got this bike, and I know that I can buy this bike at the store for we'll say $450, but this friend of mine in the neighborhood keeps telling me, hey, I want to buy your bike. I love your bike. Will you sell your bike? And I say, no, it's not for sale. I'm not selling my bike to you. Sorry. And finally, one day he says, you know what? I asked my parents, I'll buy your bike for $500. And you're like, $500? Wait a minute. I can buy this bike at the store for $450. So you say, screw it. I'm taking the deal. So you sell your bike to him for $500. You take that $500 to the store, you buy the same bike you had, but now it's brand new for $450, and you made $50. That is probably the easiest way to understand or explain what shorting a stock or shorting an investment means. So hopefully that made sense. If it didn't, shoot me an email and we can chit chat about it, maybe on the phone. High volume stocks. The only thing I want to say about high volume stocks is that they're pretty simple. Even at our office, we're placing huge trades at our office because, we manage over $100 million in client assets, which means that whenever we place a trade, we're placing trades that are, millions of dollars and, thousands, tens of thousands, hundreds of thousands of shares, depending on the price of the stock in question or price of the ETF, which we'll get to in a minute. So whenever it's a really high volume stock, in most cases, because it's trading at so many shares per minute, not just per day, but per minute, then we can place a trade for, let's just say 170 of our clients to buy a 3% position in a high volume stock. And that trade goes through right away, what's called the big bid-ask spread. So the difference between the buying and the selling price is very, very narrow. It might be, we'll say $50.23 a share by $53.25 a share. So there's a 2-cent spread, and that's it. And so when we place that trade to buy or sell, we essentially get execution at a price that's very, very close to whatever the market's doing. This is contrary to low volume stocks. So stocks that don't trade at a very high volume on the market, they're a little bit different, a little bit trickier. We have to be more careful in terms of how we place those trades. The first and biggest reason is, for the past 10 years, we hear occasionally questions from clients about, hey, what do you think about high frequency trading, or front running? Front running is where literally traders or companies that trade that are closer to the exchanges, like the New York Stock Exchange or the Amex, will look for a trade that's coming and in nanoseconds place trades ahead of yours in order to take advantage of the trade they see coming as it moves the market. So to avoid front running and avoid high frequency trading, there's a couple strategies you can use. And it's especially important when you're looking at low volume stocks. Because let's just say we want to sell a stock that we own and it trades at 400,000 shares per day, but we're selling 200,000 shares across all of our clients' accounts. If we were to sell 200,000 shares of a stock that trades at 400,000 shares per day between 9:30 and 4, we're going to move the market if we click the button and just click sell. And not only going to move the market in that stock, the stock's literally going to go down because of our trade, because there's not going to be one trade at 200,000 shares. It's going to be a trade at 1,000 shares, maybe a trade at 1,400 shares. And every trade that goes into the market until we hit 200,000 shares is going to be at a lower price, because whenever sells take place, that pushes the price of that stock down lower. So when we're placing a trade to sell 200,000 shares of a stock that trades at 400,000 per day, we have to do it in a different way. The first way we can do it is through what's called a limit order, but the way we like to do it is through what's called a rotary, or like a cycle exchange. So what we do is say, let's trade 1,200 shares every 28 seconds across 6 different market makers, and then with a 10-cent limit, let's just say. Now, I know that sounded pretty confusing, but here's what that means. So if the stock is trading at 50, then I'm going to put the limit at $40.90. So I've got 10 cents in wiggle room. And what's going to happen is the system, or the trading software, is going to automatically sell 1,200 shares every 28 seconds. So the first thing that's happening is we're not showing our cards. We're not showing our cards to the market, to market makers. Nobody knows what else is coming behind that next trade, first of all. So, and then I'm using 1,200 shares instead of 1,000. So it's not an even amount. Makes it look like it's the only trade when it might not be. Then we're doing it across 6 different market makers. So by going to different market makers, the first 1,200 goes to Citadel. The second 1,200 goes to another market maker, and so on. By doing that, you're further hiding your cards, so the high frequency traders and front runners cannot figure out what's happening. They can't figure out how big the trade is, where it's coming from, who's doing the trade. It's entirely too confusing. So what we're able to do is, let's just say the first trade goes through at 50, the second goes through at 49.98, the third goes through at 49.96, and then all of a sudden it hits 49.90 after maybe, let's just call it the 30th trade, and then all of a sudden it's at 49.89. Now it stops. So automatically this system stops. And what happens is it waits until the price gets back above $40.90 a share. Then it starts selling again. So, and again, it goes around that rotary to 6 different market makers over and over and over again. And then it might take 2, 3, 4 hours for this trade to fill, meaning it might take 2 to 4 hours or longer even for all 200,000 shares to be sold, depending on how the market goes that day. What ends up happening is our clients get the average price of all the trades that went through. So let's just say from the highest sell at, say, $50 a share to the lowest one at $49.90. Let's just say that the average was $49.96. That average was what our clients get when we sell the stock. So that was a much longer bullet point than I planned on it being, but I get excited about this stuff, and I think it's pretty cool. So hopefully that was interesting to you as well, and you didn't hit stop or close your window or turn off the podcast here. But that's how you trade low volume stocks. Another way to do it is much shorter. There's what's called the dark pools. Dark pools are going out and seeing who in the darks has stock that they want, and if they want stock that you have, then you can sell it to them off the market. Essentially, it's almost like selling a house before it hits the market, that kind of thing. Same goes on the buy side. So if you want to buy stock, you can go to the darks and then buy a stock off market, so to speak, and come up with a good price. So hopefully that'll make sense. Again, if you have questions, if it doesn't make sense, let me know. But all the things we do here at our office from a trading standpoint are done what's called block trading. So we only manage, I shouldn't say we only manage because 18 is a lot, but we manage 18 model portfolios for our clients, and our clients own 1, 2, or 3 of these models typically, just depending on whether they want to own a trend following model versus a strategic model, whether they want to be invested in, aggressive, moderate, balanced, conservative, and so on and so forth. If they want an ESG model, a socially responsible model, we have one of those as well. So anyway, all of our clients own 1, 2, or 3 of these 18 models. And what we're doing is we're just watching 18 portfolios on a daily basis. So it makes it a whole lot easier than watching 360, 370 clients' portfolios, because we have about 370 clients. So by having 18 model portfolios, it makes it much, much simpler. And whenever we buy or sell a stock, we're buying it across the board for all the clients that own that model, or we're selling it for all the clients that own that model. So again, hopefully that makes sense. All right, switch gears here, talk a little about exchange traded funds. So ETF trading, it's a little bit different. It's a lot like stock trading, because unlike mutual funds, exchange traded funds are like stocks because they're traded on an exchange, like the NYSE, the Amex. So when you trade an exchange traded fund, that's why they're called exchange traded funds, because they're traded on the exchange. Obviously, we just call them ETFs for short, but they trade like stocks. So when you buy or sell a mutual fund, on the other hand, you place the trade at, let's just say, 9:30 in the morning, but you have to wait till the end of the day before you get your price at 4 o'clock. And that would be the same whether you bought a mutual fund or sold one. With an exchange traded fund or ETF, the way it works is you buy an ETF or sell it at, say, 9:32 in the morning, you get the price at 9:32. You buy or sell an ETF at 12:30 p.m., you get the price at 12:30 p.m. So much more flexible from that standpoint. You can actually short the market using ETFs. They're actually called inverse ETFs. So it's not like you're actually shorting the ETF like you would short a stock, but you can basically buy an inverse S&P 500 ETF, for instance, where if the S&P were to go down 10%, you would make 10%. That would be an inverse ETF. You can also get crazy and aggressive, and you can start look at 2 times inverse, so leveraged inverse, which would be, 2 times inverse the S&P would be if the market goes down 10%, you make 20%. Now, of course, the problem is if the market goes the wrong way and trades against you and it goes up 10%, then you just lost 20%. So it can get pretty confusing. And again, anytime you're talking about shorting the market or using leverage, you really have to pay attention. And I don't mean just pay attention, but you have to pay close attention. Next thing is volume's really not an issue. We talked about volume with stock trading. If it's a, high volume stock, it's not really much of an issue. We can kind of place the trade and pretty much we have our price almost instantaneously. Whereas if it's a thinly traded stock that trades at, I mentioned 200,000 shares, but being purchased or sold in a stock that trades at 400,000 shares per day, that can be, a problem. And we have to get creative in terms of how we place that trade. With exchange traded funds, it's different. Volume's not an issue because there's this thing called share creation and share redemption, first of all, where shares are literally being created that mimic the basket of stocks the ETF represents, because that's all ETFs are. They're baskets of stocks, baskets of bonds, baskets of commodities, large cap, mid cap, small cap, value, growth, international, domestic. So it's a basket of anything you could possibly imagine these days. I don't even know how many ETFs there are out there these days, but well over probably 15,000 choices at this point. And I'm probably way off. I'm just guessing here, but we got share creation, we got share redemption, but we also have these things called risk quotes. And whenever we place a trade in an ETF, not all ETFs, because some ETFs are traded at a very high volume per day, but many of them are not. And so the way that works is, let's just say we want to sell, and this can happen a lot, by the way. Let's just say we want to sell 200,000 shares of an ETF, but it only trades at 15,000 shares per day. If you do that math, it's going to take days to sell that ETF if only 15,000 shares are wanted on the other side of the trade. So when you sell 200,000 shares and it's only trading at 15,000 shares a day, theoretically, one might think, well, there's only buyers on the other side of the trade at 15,000 shares. Now, that's not the case. If you sell 200,000 shares in an ETF that only trades at 15,000 a day, you'll still sell it that day. You're just probably not going to get a very good price. In fact, the price could be horrible. The bid-ask spread, remember earlier I was talking about bid-ask spreads on high volume stocks being, let's just say, I'll just use another example, say $50.23 by $53 and $50.23 by $50.25. So a 2 cent spread. The ask bid spread on an ETF that trades thinly could be enormous, or as the traders like to say, you could drive a truck through it. It's so wide. So what a risk quote is, whenever we place a large trade in an ETF that's thinly traded, we reach out to a trader, and we've got traders all over the country, and we'll say, hey, we're looking to sell 200,000 shares of XYZ, we'll call it, just, a symbol of whatever ETF we're selling. And what the trader does is they go out to the market and they basically get bids. So they'll get bids from 1, 2, or 3 different market makers. And they don't tell the market maker whether we're buying or selling. They just say there's a trade for 200,000 shares. Because if we told them they were buying, then all of a sudden they're going to be biased and they're going to give us a bad price. If we tell them we're selling, it would be the same thing. So the trader just says, we've got a trade for 200,000 shares of XYZ. And then the bidders come back with a price at the bid and the price at the ask. And basically it's a really, really narrow spread, and you get the best price and best execution. So you can pretty much buy and sell pretty much almost, I don't want to say virtually, literally, but virtually almost any volume you want of ETFs, regardless of how many shares they trade at per day, because you can get a risk quote. Go out to the market, and there's always somebody out there that's looking for either to purchase or to sell however many shares you're looking to buy or sell of that ETF at a very, very reasonable price, at a great execution. So that's how that works. Pretty cool. And again, with block trading, with all of our 18 models, when we're buying ETFs, selling ETFs, it works exactly the same way as it does with individual stocks. So, if we're buying, let's just say an AI index, like a technology index with AI stocks. We'll just call it 8% across 8 different portfolio models. Then we're pulling that 8% essentially from all of our clients' accounts to find out how many shares it is. All those shares get put into one account so that we can buy it and work that trade however we want to do it, whether it be hitting the market with the trade, doing a risk quote, or otherwise. And then again, once the shares are purchased, they get allocated to the client's accounts at 8% based on their portfolio value. Or if we're selling them, obviously, we're just allocating the cash, the redemption of those shares to each client's account at whatever percentage it was owned. So again, hopefully that makes sense. Last thing we'll talk about here, bond trading. A little bit different. Just all 3 of these are just a little bit different from one another. Stock trading is a little bit different from ETF trading. And bond trading is a little bit different from both of them. The way bond trading works is you're buying at the ask, and this is, by the way, all trading actually. You buy at the ask, and then you sell at the bid. So let's just say we want to sell a bond. What we want to do is go out and get bids in the market to sell that bond. If we're looking to buy a bond or like these days, we've been doing a lot of buying treasury bills, which are short term, like 1 to 6 month treasury bills. And the reason we've been buying these primarily, it's for people who have really large lump sums of liquid money they need to keep liquid. A lot of the cases, it's tax money. So, we've had a couple companies, who are clients who've sold their companies, and they owe, let's just say 400,000, 700,000, 1.5 million in taxes come April 15th of 2025. What we'll do is we'll take the proceeds from the business, figure out how much we think we're going to owe in tax. We put that in a separate account, and then we buy T-bills paying right now 5.3, 5.4, 5.5, 5.6% even. And we just keep rolling those T-bills forward every 3-6 months or so until the tax day comes, at which point then we pay our taxes. But we were able to do 2 things. One, we were able to get some good, safe interest on that money as opposed to just letting it rot in our savings account. And then the second thing we're able to do is essentially reduce our capital gains tax, because obviously we make a little bit more money on it. Therefore, our total tax is lower on a net basis at the end of the day. Of course, when you make money, you got to pay tax on it, right? So even that 5.4 to 5.6%, that also gets taxed. But still, it's a whole lot better than making nothing, right? The second thing to understand about bonds is that they fluctuate with interest rates. And this is what's been happening with bonds actually this past few years that most people probably don't even realize. Most investors don't realize this, is that when interest rates go down, bonds go up in value. And when interest rates go up in value, so bonds go down in value. So they're inversely related. So from the 1970s and 80s until 3 years ago, interest rates pretty much went down, or at least, even if there were times when they went up, it was temporary, but they were generally going down over time, which is why bonds did well. It was a bull market for bond, call it a 30-year bull market for bonds. It's also why people would say bonds are good diversifier. When stocks go down, bonds help diversify. They might say when stocks go down, bonds go up. Well, that hasn't been the case this past few years. And people, especially conservative investors, unfortunately, and that's really the saddest part about all of this, is that conservative investors have had their portfolios absolutely decimated because there's so many brokerage firms out there. There's so many financial advisory firms, broker dealers that have these compliance departments that say that you have to have, if you're a conservative investor, let's just say, in a conservative portfolio model, they say you have to have 55%, 60%, 65% of your money invested in bonds. And then on top of that, they don't drill down and look at, the fact that because the Fed has been raising rates or had been raising rates for, 2.5 years, and thus bonds are going to get killed. They don't think about that. They don't use that in their pie charts. What they do is they say you have to own bonds. And so They look at whatever bonds they can find. They put them in the portfolio. Compliance departments held harmless. The financial advisors held harmless. But at the end of the day, the portfolio goes down in value, not just because stocks go down if they go down, but also because bonds are going down as well. And this is why 2021, 22 were such tough years for most people, was because not only did the stock market go down, 20% on the S&P in 2022, 34% on the NASDAQ, but bonds were down. The bonds as an aggregate were down 16 to 18%. Corporate bonds were down, 20 something percent. Treasury bonds down almost 30%. When you look at, from the top of the market at COVID, the top of the bond market, I should say, until now, Treasury bills are down 40, 50%. It's, so, and again, these pie charts, these traditional pie charts, think of it like the food pyramid, are a little bit outdated. And especially as the interest rate environment changes, it's going to be important that investors change and investors adapt and realize that, going forward, if interest rates aren't going to continue staying low and going lower, then it's going to be extremely important to pay close attention to your bond portfolios or the bond sleeve of your portfolios. All right, I'll shut up. That was, obviously, I'm a little passionate about this topic. So, the other thing with bonds is if you're buying individual bonds, be really careful with maturity dates. So I mentioned earlier that we are, for clients who own businesses that they've sold, we take their tax dollars that they're going to owe and we put it in T-bills, but these T-bills are 3 months, 4 months, 6 months. We're not talking about long maturities here. It's not a big deal. And we're getting great interest rates that are guaranteed in a short period of time. Whereas if you're buying individual bonds and you're looking at things like corporate bonds, if you're looking at long dated, debt of any kind, municipal bonds, be really careful, because even though you might get a great rate right now, if rates start coming down in the next year or two, what's going to happen to the bond values is they're going to go up, right? Now, it might be a good thing, but your interest rate to roll that bond forward when it matures, obviously you'd have to pay up, or technically pay down, to get a lower rate. So right now, the price of bonds, the probability, I should say, of the price of bonds going up over the course of the next year or two is probably high. Again, that's not a guarantee. I'm not making any guarantees here, but your bond, if you buy a 10-year bond, let's just say, between now and 10 years when it matures, you're going to get the interest rate you paid for. Let's just call it 5%. But if interest rates go down here in the next year or two, then the bond could be worth more in addition to you getting that 5.4% if I said 5%. So in addition to 5%, your bond could be worth more because interest rate went down, and when interest rates go down, bond values go up. That's a good thing. However, when you go out 5 years, are interest rates going to be lower than they are today? I don't know. 10 years from now, if interest rates are higher than they are today, then the bond could be worth less, obviously, than what you paid for it. Now, the good news is, as long as it's a safe bond, as long as it's maybe insured, then when it matures in 10 years, then you get your original investment back, plus the 5% you got per year. So that's the good news. But I'm probably going too deep here. This is supposed to be 101. I feel like I'm giving you 201 and 301, so my apologies. And the last thing with bonds is that for many investors, instead of buying bonds with 10-year maturity dates, 15-year maturity dates, 20-year maturity dates, bond ETFs make more sense because they're liquid. They have maturity dates inside them, but you can buy and sell them at any time with the click of a button. The interest that they get is going back into the bond ETF. They're being reinvested, and they grow in that way, as well as through principal appreciation as well. Again, bond ETFs can go down though. Again, just like bonds, whereas interest rates go up, the bond ETFs will typically down in value, with the exception of some bonds that maybe, like if they short the market. So we talked about shorting earlier. You can short the bond market, which means if interest rates go up and bonds go down, by shorting the market, you would actually make money if the bond market's going down. It gets kind of complicated, but there's also convertible bonds that convert to stock. They have a tendency to be more volatile, a little bit more risky. However, when the stock market does well, these bonds tend to do a little bit better than traditional bonds. So, there's all kind. We could dive into the weeds deeper here, but I'm not going to do that. So today, we're just going to close down. Hopefully that was interesting, not only when it comes to the new trade laws that just went through for T+1, as well as all the 101s I just gave you on stock, ETF, and bond trading. Hopefully that was interesting to you. So, look up and subscribe to our pages across all the socials on Instagram, YouTube, TikTok, Twitter. Our website, again, is libertaswealth.com. You can email us there. You can click on a little button to find out if we're a good fit. And of course, there's always links, contact info in the show notes as well. But as I always say, there's thousands and thousands of podcasts out there, and you chose to give ours a listen today. So thank you so much for tuning in, and we'll see you next time.
Thank you for joining us on the Retirement Fiduciary Podcast. To see any charts or images that were mentioned on this show, to check out additional articles, videos, and other educational resources, or to set up an intro call with your host, Koos, just head over to libertizewealth.com. This podcast is for informational and entertainment purposes only and should not be relied upon as a basis for investment decisions. None of our shows engage in rendering legal, financial, tax, or other professional services. Always talk to a certified financial planner or fee-only fiduciary financial advisor before implementing any of the ideas shared in this episode.